Welcome to this explainer. Look, today we're going to strip away all the market noise and unpack a really powerful 10-step playbook. It's designed to help you shift your mindset from, well, basically gambling to methodical, highly effective stock analysis. If you've ever felt completely overwhelmed by the sheer volume of choices out there, or maybe you've been burned chasing some random social media trend, honestly, you are in exactly the right place. We're going to break down how to analyze companies just like the pros do, making every single step crystal clear. Let's get into it.
Okay, imagine this massive contrast for a second. On one hand, you've got the ultimate investing dream, right? Taking a modest sum, say $1,000, and watching it steadily compound into 10,000, 50,000, or even 100 grand over time. But on the other side is the absolute nightmare. You buy the wrong stock, you try to catch a falling knife, and you literally watch half of your hard-earned cash just vanish into thin air. It's brutal. And the difference between these two totally different realities, it almost always comes down to one fundamental skill: knowing exactly how to pick the right stock. And that brings us to a golden rule, maybe the most important rule of all. Great investors don't gamble. They analyze. We are taking a massive step away from the hype today, guys. We're tuning out the daily noise and moving toward patient, research-driven decisions. Because the best investors in the world, they aren't just guessing. They're researching, they're comparing, and they're investing with an extreme amount of patience. So, here's our 10-step playbook for today. We are going to cover the investing framework, understanding the business, checking financial health, leadership and valuation, the red flags you absolutely need to avoid, and finally, we'll wrap up with the golden checklist. All right, moving right along to Section 1, the investing framework. It's time to shift your mindset. It's so easy to just open your brokerage app and stare at those 3 or 4 letters blinking red and green on the screen. But here's the thing you have to remember. You must invest in businesses, not just stock symbols. Behind every single ticker is a living, breathing operation. Whether it's tech, healthcare, finance, you're buying a piece of an actual real-world operation. If you lose sight of that, well, you start treating the market like a casino instead of a marketplace of real businesses. Let's jump into Section 2, Understanding the Business. This is Phase 1 of our playbook. Welcome to the 1-minute test. Can you answer these 4 questions? What products or services does the company actually sell? How exactly does it make its money? Who are its customers? And who are its competitors? I mean, it sounds incredibly simple, right? But you would be shocked at how many people dump thousands of dollars into a stock without being able to answer these basic things. So apply this test to every single stock you look at. If you can't confidently answer those 4 questions in under 60 seconds, literally just put your wallet away. Okay, so once you know what they do, you really need to figure out why they're going to survive. Think of a business like a giant castle. To survive enemy attacks, it needs a lasting competitive advantage, an economic moat. Are they surviving because they have this massive, globally recognized brand? Do they have insanely loyal customers? Maybe they hold essential patents, or they've got some advanced tech that's just super hard for anyone else to replicate. And things like network effects, where a product gets more valuable the more people use it, or cost leadership, those are absolute game changers. Finding a company with a strong moat means you've found something built for long-term growth. Next up is Section 3, Checking Financial Health, which brings us to Phase 2 of the playbook. So the first major indicator here is earnings per share, or EPS. Now, a company selling billions of dollars of products sounds fantastic on paper, doesn't it? But evaluating net profit, profit margins, and EPS, that ensures you're looking at a company with genuine financial strength. Because look, some businesses pull in massive revenue, but they actually bleed money every single quarter. EPS breaks down a company's profit on a per-share basis, basically proving that they are generating actual bottom-line wealth for their owners. And hey, that includes you, the investor. Now, the contrast between a safe and a dangerous balance sheet is honestly pretty stark. A healthy company is going to show steady revenue growth over a 5 to 10-year period, and they hold enough cash reserves to actually weather an economic downturn. A dangerous one? You're looking at stagnant sales and a company basically living paycheck to paycheck. And keep in mind, responsible debt can totally fuel growth, sure, but excessive, compounding debt, that is a massive wealth killer. Our final financial health check is return on equity, or ROE. This metric essentially tells you how good the company's management is at using your money to make more money. So a consistently healthy ROE indicates really strong management efficiency. But, and this is a critical pro tip here, always remember to compare ROE only with similar companies in the exact same industry.
The baseline for what makes a good ROE in a high-growth tech stock might be completely different from what makes a good ROE for your local utility company.
All right, Section 4, Leadership and Valuation. We are now in Phase 3 of the playbook.
You've got to ask yourself a super critical question about the people running the show. Do the CEO and the management team have a solid reputation and a real history of clear communication? You absolutely must research this. A highly capable management team can steer a company through some really tough economic times and keep the ship afloat. But poor leadership, man, they will eventually sink even a fundamentally brilliant business.
Okay, so let's say you love the business. The financials are solid, the management is top tier. You still have to look at the price. Why? Because even the absolute best company in the world is a terrible investment if you drastically overpay for it. And that's where valuation metrics come in. You want to look at the price to earnings ratio, price to sales, and price to book. Now, you don't necessarily need to be a math genius for this, but you absolutely have to compare these three metrics against the company's own historical averages and against its direct competitors. If a stock is trading at a P/E ratio that's, say, triple its historical average, you really have to ask yourself why you'd pay such a massive premium today. Let's move into Section 5, Red Flags to Avoid. This is Phase 4 of our playbook. It is time to choose your fighter, the patient investor versus the anxious investor. Look, history overwhelmingly shows us that patient investors who spread their risk across different sectors, meaning, they actually diversify their investments, they benefit massively from long-term economic growth. They aren't putting all their eggs in one basket, and they plan to hold for years. The anxious investor, on the other hand, hyper-focuses on daily price volatility, dumps all their capital into one trendy stock, and makes poor emotional choices based on what the market is doing on a random Tuesday. Trust me, you want to be the patient investor.
When you're digging into these companies, you need to watch out for these 7 critical warning signs. Are profits declining year after year? Do they have very high, basically unmanageable debt? What about constant sudden management changes or sketchy accounting controversies? Also, definitely beware of CEOs making these unrealistic, rapid growth promises. Watch out for poor corporate governance or a stock price that is completely disconnected from actual business performance and driven entirely by internet hype. If you're analyzing a stock and you see several of these red flags clustering together, just walk away. Seriously, don't risk it.
And finally, Section 6, the golden checklist. Let's bring this all together.
Before you even think about hitting that buy button on any stock, you need to run it through this 10-question gauntlet. Just ask yourself, do I actually understand the business? Is the revenue growing? Is the company profitable? Is its debt manageable? Does it have a clear competitive advantage? Is the management trustworthy? Is the valuation reasonable right now? Is my portfolio currently diversified? Can I hold this investment for at least 5 to 10 years? And am I acting based on research rather than just pure emotion? If you can confidently answer yes to most of these questions, it means you have likely found a really strong, value-creating candidate.
Which brings us to our final and honestly most important question for you to chew on. Are you investing based on rigorous research or are you just gambling on emotions? True wealth, the kind that lasts, isn't built on luck or chasing whatever social media trend is popping off today. It's built on informed, methodical decisions. It's about truly understanding the business and managing your risk over the long term. So the very next time you open up your portfolio app, which investor are you going to choose to be? Keep analyzing, keep learning, and we'll see you next time.